Hedge funds or Ponzi schemes, the hidden dangers you need to know. All right, picture this. You're at a high-end cocktail party, sipping on an overpriced drink when someone whispers, "I know a hedge fund that guarantees 20% returns every year." Sounds too good to be true, right? Well, sometimes it is. While hedge funds can be powerful investment tools, some operate eerily like Ponzi schemes, promising the moon while secretly scrambling behind the scenes to stay afloat. So, how can you tell the difference? Let's break it down into simple terms without the confusing financial jargon. Just fun, facts, and a little bit of common sense. First things first, what even is a hedge fund? Think of it as an exclusive investment club where wealthy individuals and institutions pool their money, trusting a fancy-sounding manager to make them rich. Unlike mutual funds, hedge funds can bet on anything: stocks, bonds, currencies, derivatives, even bizarre things like fine art or weather patterns. And yes, that's a real thing. But here's the catch. Hedge funds don't always reveal how they make money. They use complex strategies, vague descriptions, and substantial amounts of financial wizardry. And sometimes, that's a problem. So, how do some hedge funds start resembling Ponzi schemes? Let's take a look at the warning signs. They may have vague investment strategies. If a hedge fund manager uses words like proprietary algorithm, exclusive market insights, or trust me, I'm a genius, without specifics, it's time to be skeptical. Transparency is key. They may boast consistently unrealistic returns. Real markets go up and down. If a hedge fund claims steady, high returns regardless of market conditions, it may be using new investor money to pay off earlier investors, just like a Ponzi scheme. They may employ high withdrawal restrictions. Some funds make it nearly impossible for investors to pull out their money. If you're told withdrawals are temporarily paused or we need more time, that's a red flag alert. They may utilize overly aggressive marketing. A hedge fund should not be begging for your money. If they're throwing around fancy parties, luxury trips, or high-pressure tactics to recruit new investors, watch out. History has seen some truly shocking Ponzi schemes. Here are a few of the most infamous. Bernie Madoff, the mastermind behind the largest Ponzi scheme in history, defrauding investors out of $65 billion with promises of steady returns. Charles Ponzi. And yes, he's the original Ponzi schemer from the 1920s who lured investors in with a fake postal coupon investment scam. Alan Stanford. He ran a $7 billion Ponzi scheme by convincing investors that he had exclusive offshore banking opportunities. And let's not forget Lou Pearlman, the music mogul who managed NSYNC and the Backstreet Boys, but also orchestrated a $300 million Ponzi scheme, defrauding thousands of investors, including everyday working class people. So, what do they all have in common? Secrecy, false promises, and financial ruin for those who trusted them. And if you think only the wealthy fall for financial scams, think again. While high net worth individuals are prime targets, the working class is often hit even harder, losing life savings and retirement money in Ponzi-like hedge fund schemes. The working class's retirement funds are especially at risk. Many Ponzi-style investments are structured as safe retirement vehicles, luring in hard-working individuals trying to secure their future. Pensions and 401ks also have vulnerabilities. Some fraudulent funds attract employees through employer-backed pension plans, tricking them into redirecting their retirement contributions into high-risk, unsustainable schemes. And then there's desperation for higher returns. In tough economic times, many working-class investors look for higher yield options and can easily fall victim to promises of fast money. So now, what are the possibilities of recovery from a Ponzi scheme? Well, the odds of recovering lost money are slim. In Madoff's case, only a fraction of the victims ever received compensation. Legal battles can take decades, with victims fighting over what remains of the fraudulent fund. Government agencies, like the SEC or the FBI, may attempt to seize assets, but most victims never fully recover their losses. So, how do you protect yourself from falling into a hedge fund trap? Follow these golden rules. Demand transparency. If a fund manager can't explain their strategy in plain English, walk away. Also, verify past performance. Don't just trust glossy reports. Look for third-party audits and independent reviews. Be wary of exclusivity. Just because an investment is invitation only doesn't mean it's legit. Scams thrive on exclusivity. Make sure to understand the liquidity terms. If you can't access your money when you need it, that's a huge red flag. And most importantly, check for regulatory oversight. Make sure the hedge fund is registered with financial authorities like the SEC, US, or the FCA, UK. Lack of oversight equals potential trouble. Hedge funds can be powerful investment vehicles, but when secrecy, too good to be true returns, and withdrawal restrictions creep in, they can start looking a lot like Ponzi schemes. Remember, if something feels fishy in finance, it probably is. Stay sharp, ask questions, and never invest in something you don't fully understand. Like, share, and subscribe, and make sure to check back here regularly for more insights into the wild world of finance.